Friends, welcome back. Let us continue our discussion on the concept of leverage. So far, what we have understood that leverage means your rewards should be disproportionate to the effort. And always an entity tries for a positive leverage. And disproportionate means by putting less effort, your reward will be more. Effort here means your sales. And reward means the profit. Everybody wants that. Suppose I'm going to increase my sales by 10%, my profit should increase more than that. 10% sales growth brings, let us say, 15% profit. You can say this is a positive leverage. Okay. So, and how it is possible? It's possible because of introduction of fixed cost in the cost structure. Leverage comes because introduction of fixed cost in the cost structure. And cost structure means it can be the product cost structure, and it can be there in the financing structure also, or financing cost structure. Okay, so two types of fixed cost we have discussed earlier. So let me share my screen with you at this stage. If you look at here, you can understand easily that leverage comes because of these two types of fixed cost. One is your operating fixed cost like rent, depreciation, etc. Other one is your financial fixed cost like interest. These two types of fixed cost helps in creating a leverage, and because of which your reward will be disproportionate to your efforts. So as we are discussing earlier, so this particular picture shows you various formula how to compute different type of leverages. And this combined leverage or this total leverage is a function of operating leverage as well as financial leverage. Operating leverage's formula is contribution by PBI, and contribution means sales minus variable cost. PBIT means profit before interest and tax. And the formula for computing financial leverage is PBIT divided by PBT. Okay. And total leverage or combined leverage is the multiplication of operating leverage and financial leverage. So this multiplied with this. If you multiply this PBIT in the denominator, PBIT in the numerator gets cancelled. And the finally formula remains, that is contribution by PBT. PBT means profit before tax. This is how we'll be able to compute these three types of leverages. Okay. This is what we have already discussed so far. Now look at the formula here. Total leverage is the product of operating leverage and financial leverage. Therefore, the formula here is contribution by PBIT multiplied with PBIT by PBT. So effectively what happens is PBIT get cancelled and the formula is contribution by PBT. This is what you have to remember for computing total leverage. Right. At this concept will be at this level, let us learn one more concept, and that is leverage is linked to the risks. Okay, risk means, as you already know in financial management, when we talk about the risk, we mean that disproportionate in this, or you can say variability in the return is the risk. And the variability of return happens because of fixed cost. And as we have already said, there may be operating fixed cost. There might be financing fixed cost like interest, and all taken together, both of them taken together, there might be total fixed cost. Right. This operating fixed cost gives you operating leverage. Financing fixed cost gives you financial leverage, and the total fixed cost gives you combined leverage or overall leverage. And formulas that you have also already seen now. For operating leverage, we'll be using the formula contribution by PBIT. For financial leverage, we'll be using the formula PBIT by PBT. For combined leverage, we'll be using the formula contribution by PB. Okay. Now, how to remember this formula? This is what we call it as leverage structure. You can call it as the cost profit structure also. We need to remember this so that it will be easier for us to remember the formula. First, you can take the sales. Sales means what is the per unit sales price. I repeat, per unit sales price. Suppose we are producing something. Per unit it is sold 10 rupees. That is the sales. Minus variable cost. Here also we'll be taking per unit. What is the variable cost? Sales minus variable cost. You are getting a figure that is called as a contribution. You have to remember this contribution. From contribution, if you deduct operating fixed cost, you'll be getting PBIT. So contribution minus operating fixed cost, you'll be getting profit before interest and taxes. Therefrom, if you're deducting interest, you'll be getting profit before taxes. Then tax is paid, you'll be getting PAT, that is profit after tax. You can calculate earning per share or EPS, which is the PAT divided by number of equity shares. So you have to remember this order. Once you have remembered this, you can calculate operating leverage. Operating leverage arises because of operating fixed cost. So here is operating leverage because of this operating fixed cost. The formula for is that, let us say we are calculating operating leverage, one step up and one step down. That means formula is contribution by PPA. Similarly, financing leverage comes because of interest. This is financial leverage. So the formula is one step up, one step down. That is PBIT by PPA. If you take both the fixed costs, you'll be getting combined leverage, the total leverage. The formula is contribution by PBT. So this is the formula you have to understand. Okay, and this operating leverage is measured in terms of times. Okay, well, measures the change in PBIT for every change in sales. That means if sales changes by 10%, how much PBIT changes? That is called as operating leverage. Okay, if operating leverage is 3, sales changes by 10%, then PBIT will change by 30% because OL is 3. Okay. Similarly, financial leverage is also measured in terms of times. It measures the changes in PBT or earning per share for every change in PBIT. For example, if FL is 2, financial leverage is 2, PBIT changes by 30%, then PBT will changes by 60% because FL is 2, financial leverage is 2, so 30 into 2 is 60%. Total leverage is also measured in terms of times. Total leverage measures the change in PBT or EPS for every change in sales. That is, if the total leverage is 6, sales increases by 10%. Profit or EPS should increase by 60% if you're having total leverage of 6. Okay. Now let us see, with the help of an example, how to compute these leverages. Here is an example. Let us say sales is 10,000 units. Sales price is 20 per unit. Variable cost is 12 per unit. Fixed cost is rupees 20,000. Interest is 10,000. Tax rate is 30%. Prepare income statement and compute 3 leverages. Please have a look. Sales will take per unit is available. We can take it a total also. Total sales is 10,000 into 20, 2 lakh rupees. Less variable cost 10,000 into 12, 1,20,000 rupees. So contribution, it is the total contribution is 80,000. Per unit contribution, how much? We can do like this, 20 minus 12 is 8. Okay, per unit contribution we can find out, multiply with 10,000, we'll be also getting 80,000. Once this total contribution is arrived at, total contribution, we can take the total sales minus total variable cost, or per unit sales minus per unit variable cost, and the final figure is to be multiplied with the units, number of units of sale. Total contribution is 80,000. Fixed cost question says 20,000. That means profit before interest and taxes is 60,000. If I deduct the interest of 10,000, PBT is 50,000. Tax is 30%, that is 15%. PAT is 15,000. In this example, we'll be calculating what is operating leverage. Very simple. You see, operating leverage is contribution by PBIT. It's 80,000 by 60,000. It is 1.33 times. Financial leverage is PBIT by PBT. That is 60,000 divided by 50,000. It comes to 1.2 times. Total leverage is contribution by PBT. That is 80,000 by 50,000. It is 1.6 times. So in this entity, this is the leverage which is paid. That means if contribution increases 10 times, PBIT will increase by how much? 10 into 1.33, 13.33 times. Okay, so like this. Okay, so this is how the leverage is to be computed. This is how leverage has to be analyzed. One more thing you have to understand. Leverage is good and it is also a dangerous thing. So I say, let us say leverage, total leverage is, let us say 1.5. That means what? That means if the sales increases by 10%, my profit will increase by 15%. But that also means if the sales decreases by 10%, my profit will also decrease by 15%. So leverage is like a double-edged sword. It is good, it's bad also. So normally a finance manager should keep the leverage moderate. If operating leverage is high, financial leverage is high, my total leverage will be high. If operating leverage is high, but financial leverage is low, my total leverage is moderate. If operating leverage is low, financial leverage can be high, total leverage can be still moderate. If OL is low, FL is low, total leverage will be also low. Okay. So every time a finance manager has to decide that how he can keep his leverage moderate. If operating leverage is already high, then he should take less amount of loan so that financial leverage will be low and overall leverage will be moderate. Okay. So in this chapter, you see, once you've understood the concept that this is what leverage is, it is more important to understand what is leverage, what is the use of leverage. Then you have seen it is only formula. By using that formula, you will be able to compute all these leverages. One question you have already done, so you can do other questions also. Okay, hope things are clear to you. Okay. So we'll stop our session here today. Thank you very much.